Okay, hello. You know, this is hard. Uh, I think Sanchez, somebody sent me a message and told me to continue with this tax equity material. I really want to get off this because I think I have much more exciting things to say, maybe not for you, but for me, on subjects like the economic value of hydrogen in the context of an overall utility system, not Pazon, not in a just for a single kind of project. And I'm working very hard on my uh, theory of finance stuff. Okay, but I'm going to continue. Now, when I continue, okay, I'm going to talk about a couple of things in this model. Okay, first, perhaps I should start with where I left off. And unfortunately, um, you know, I talked about this development fee, and I'm getting totally obsessed with that because the measurement of returns and including startup costs in returns is such a big issue. And realizing that you have to have a whole different method of economic analysis for cash flows where you have a big possibility of getting nothing. It's like a default, it's like a probability of default, and you can't use the traditional IRR BS. No, I'm not going to say IRR BS because I like IRR basically. But how should we incorporate this IR? So I'm going to finish that off first. And then, and I put some blanks in here. So we just have a series of so many IRRs. Then we're going to compute the IRRs for the what we'll call the sponsor. And I don't know if I'd almost say I'm not allowed to call it the developer. It's almost better to call it the developer because the developer is taking that upfront risk, not the tax equity investor. So when we really look at a equitable kind of distribution of the IRR, we're going to get some surprising answers. And this IRR for the tax investor is going to be typically extremely high. And a lot of people will say, that's just distortions in the way the IRR is computed. And I say, no, it isn't. It really isn't. I mean, IRR has this investment reinvestment rate headache that most people should know about. It's got an implicit assumption that any time you get any money, you can reinvest it at that rate itself. So this, if we get a really high IRR, something like this, we'll see once we correct it if it's anything like that. It assumes that you can take that money and reinvest it at that. And okay, that's not so good. But these alternatives like MIR are so much crap, or NPV, and anything else. So maybe we can adjust this IRR a little bit, or at least talk about it now. So, but the real primary part of this session after it will be to start the financing and this. So we've got this SPV set up. We've got this partnership set up, and now we've got to split it up. And now my friend, this poor man, started to do some of this, and I don't know. And I'm gonna again have to adjust some of the inputs. What's this? Now, if you have generic macros open, do I have that open? We can get rid of the underline. Shift Control F. That's just a simple little. Uh, 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 that's a simple little recorded macro. And I have to say something else too. Let's say I have 1, 2, 3, and I want to use this and that's used in the model. So we want to cut this. We can't copy this. We want to cut this and paste this up here and transpose it. If I cut this and transpose it, Alt E, I can't do it. Alt ESV, I can't do it. So in the generic macros, uh, this just a little generic macro introduction here. I'm kind of doing this each time. Excuse me. And in the generic macros, I've got some. This is a little bit too wide. What happened here? I'm wasting your time. Sorry about that. I've got some of the things we've used. I think I messed something up here. And I've got the oh God, just a minute. I've got some other macros. This is the way this evolved. This whole thing evolved was I used to have something called FM or something, functions and macros or something like that. And then we put all together. So I put some other things in there, and here's a cut and copy, Control X. So if you wanted to then put this up in I6, you just press Control X. Oh no, Shift Control X, and it says put it in I6, and then it does the cut and paste transpose, and I'm going to do that in some of the videos. So what? Too bad if because that's a real thing. If you're trying to restructure somebody's model, it's a complete mess. That happens a lot. Now this partnership flip is not really this. This is a time based. Before we do this, let's make sure he hasn't used this somewhere else. If you press Alt MD, and it's not used anywhere else. Alt MD. For me, that's an extremely helpful little shortcut. That's an Excel shortcut. Don't worry, it's not. So we can put time-based flip. Yeah, okay. Okay, and then we've got some dates down here and some dates over here. This is this, and please, this is this horrible style. Oh, it just drives me completely nuts. So this is where Kenny is right. Don't put all this crap. If you want to input S sheet, fine, but don't start sticking this over here with your wonderful little blue things. Oh, that's so beautiful. Your wonderful little blue things, but it really screws things up. Now, I'm going to make one exception. I think it's probably okay to leave the pre-flip and post-flip here. It's kind of nice to see that. But let's start with the dates, always. And these are not really equity dates. These are allocation dates. Now, when we do this, we can, first of all, let's move this. And maybe I'm being a little, now I'm being a little hypocritical here, maybe, because maybe it really is to, here, we've got this thing, and this is the flip date, and you've got something that's, of course, criminal. Why you'd use the 5 here instead of the 5 here. That's just absolutely criminal. I should, in my generic macros, it's coming later. Hey, you wanted me to do this. Control-Alt-C. I've told you I'm going to make some import. No, not that. Get rid of that one. Okay, whoops. Oh, come on. Control-Alt-C. This audit menu, okay? And there will be, you have to pay for this crap. I can't remember what the names are. So what we really probably should do is put this here. Now, I have no idea. I just have to admit something, why the lifetime would be, why the end of the allocation wouldn't be the asset life. Okay. Oh, this is okay, I'm sorry. This is this is, instead of allocation period, this is a flip period. Okay, and I'm going to, I almost have to, my eyes are hurting now. And then we have post flip period. And this, it's project life minus E7. So that's okay. And if you put project life as a range name, so what? Not that bad, actually. Who knows? I used to get so emotional about range names, no range names. Keep range names, obviously, for VBA and macros, but nothing else. Okay, you can put them here. So then we can put post flip. Okay. Ah, now I'm going to do another one. If I could. Shit. Okay, sorry about that. Okay, and then we can make the flip date, and of course use our don't ever do this. Okay, so part of this maybe, and again, is just to say, okay, let's use some techniques. Let's press Shift Control F to get rid of this. Again, just a little bit of a self macro where you stick it on a cell, you record a macro, take it away, remove the outlines, and finish. Okay, and then we have the start period, which is the operation start, and we'll put and this is allocation. So pre pre. Why is it so small? God damn it! I'm sorry. I have to make this like this. Okay. Maybe this is my age. Again, somebody told me in the last class, aren't you too old to be doing Excel? And maybe I have to practice this to keep my mind from completely going to mush. And this time I'm going to delete these beautiful little this blue crap. It really kind of irritates me, some of this stuff. I'm sorry, I'm getting a little emotional. So this is the pre-flip begin, and then pre-flip end, which we shouldn't really need, post-flip begin, and post-flip end. And then what we're going to do, of course, this has to all be rerun, but what we're going to do is go to the allocation period, and this time I think I put this in, but we need a flag right up at the top, and I don't think I'm going to even do it, but we can put the start of the period here. That's how it should have been, that switch should have been computed, and why it's not there, who knows. And we can put the end of the period. And then in this sheet, of course, we're going to go through all of the allocations. And the first time I did this, it seemed mysterious and seemed difficult to me. But once you have the flags and once you set up the analysis, it's really not that bad. So let's look at what was done with these flags. Okay, I hadn't checked these out before, and I should have. Okay, and before I do this, control and square bracket, to get that. And that's the operation end. That's fine. And we just take that plus 1 month. So 1 day. Fine. Okay. And then let's work through let's see how we made this allocation and see how we made this thing. We did this in the timing sheet. This sucks. Okay. It really does. It really does. And then there's this horrible, stupid if statement. Oh my God, would you stop this? Okay, sorry about this, but why don't you do it like that? Okay, and if you really want it to be, then have a 1 or a 0 instead of a true or false. I sometimes like true and false, sometimes like 1 and 0. You can just do it like this, okay, and multiply it. So what? Why put this? Everybody does it, I know. I don't know why in the heck, if this is some kind of rule Kenny has or something like that. God knows what. Okay. Now, then in this brilliant thing, we're going to go down, and it's got funding here, and we have a term loan for the back leverage, which I have to explain, and we have a bridge loan for the somewhere, a bridge loan for the tax equity. And frankly, I'm sorry about this. I hope I'm not insulting my friend here and the way they set it up. It's horrible. The first thing, whenever we do funding, we need to figure out the size. Now, okay, for the split between the tax equity and the sponsor, we the way we split up the size and the investment is not any of this crap. Funding structure, we have the debt and the sponsor equity, whatever in the heck that is. We'll come back to that one. And just a minute, where in the heck is the? I've got where in the heck this what a perfect example. You want to put the funding in here, and I'm gonna have to do my first pause. Now this is a classic. What I had to do is I had to go through our partnership allocation, no, allocation to the partners, and I had to find this. Now I'm going to have to do this larger again. And I found this thing, and that's how we're saying the tax equity contribution ratio, which means that the tax investor is going to invest 1.2 times the ITC. So control and square bracket, that was in this one. And I had incorrectly, because of the mess on this input, I had incorrectly assumed this was some sort of allocation of the ITC, and I'm not going to go back and do my other video, but we will correct it in here. So in this one where I put the partnership, this tax equity write-up, in fact, the ITC write-up, which is the silly USD of thousands instead of USD. The way these people do this is just so bad, and they're too arrogant sometimes to say okay, because to say okay, I've had some things wrong in the way I make my models. I'm going to look at other models. I'm going to steal stuff from other models. And I have this project I'm working on that's billions and billions and billions, and they do this not in thousands or millions or anything else. They do it in USD. Okay, I hope I didn't give anything away. So that was a little error because the step up is going to be the same, presumably, as the as the depreciation. That'll increase our return a little bit. Okay, and so I put an extra column here, and the reason I put an extra column, this is not equity, this is partnership allocation. And for the partnership allocation, let's start with this. Let's make this wonderful person, Amen, from Togo. I'm working with him now, and he does it so well. He does it really skinny. Very good. And then we'll start with our dates. And then anytime we have financing, okay, anytime we have financing, we could start with dates. Okay, fine. But then let's after we put dates, let's put the investment, or for debts, it would be the debt size. Okay, and then when we go through the funding, we really need to let's put the tax equity bridge loan in here. Now I know the problem is because these people who gave this abusive assignment didn't list the inputs according to they put stuff all over the place, which is what you see. But every time you do this, Where in the heck is this? Come on, come on. I need to find this. Again, I'm having problems finding this total funding requirement. This is the debt. I'm looking for the tax equity bridge loan. So we've got some tax equity bridge loan. We've got a fee on this one, and let's put it together. Why would you mix it all up? Okay, and then and that it would up. This is upfront fee. Oh, sorry about taking so long to type. I'm all nervous now. And then we put our where's our admin fees? When the heck is this? Oh, I'm gonna start to cry. Oh, God damn it! I almost have to stop right now. This is the. Uh, I guess I'm gonna have to pause again because this is so bad. Okay, again, what a crime. Now, this crime, I think I'm responsible for, but we had a tax equity loan, and we start with how much the loan is, and so this is the tax equity funding, and I think what I'm going to have to do is just uh, uh, put this kind of up here, and then it's such a mess, I'm going to have to do it without the video. But the point is, we start with the amount of the funding. And once we have the amount of the funding, just with a loan, the next thing you would do is how do we get it into the project? That's the funding. And then how do we take it out of the project? So we've got the multiple, and this is instead of ITC multiple, of course, we call it something else. You can call it tax TE. I'll call it tax equity contribution ratio, which is a really big deal. They only have to put in 20% more than the ITC, which they get immediately. So they're really kind of investing 20% of the ITC. And for that, they get all the benefits of the tax losses up front, not really the tax depreciation exactly, the tax losses. And then they get this uh, uh, preferred yield that we'll go through just below. So here, then we put the cash share here, and then below that, the tax share, income loss share. Now, when you think about this, for me, it's a little bit difficult to think about sometimes. I'm going to move this over here and put, so we're going to, the next big thing is going to be TE bridge loan. And for a loan, you want to put in the amount of the loan, how the loan is going to be repaid, and what a mess. What a mess. How we size the loan, which is P90 versus P50, and how we repay the loan, which again could be based on a DSCR ratio. I said again that I didn't introduce it. And then what kind of interest and fees you pay in the meantime. Now, this isn't exactly analogous, but the next thing we should put after we put the investment in, let's put let's put the income / ownership. Now, I put ownership a little bit differently this time because this working through this project makes you think about it a little bit. And the thing you can think about is that if we have a partnership, say you have a partnership with your girlfriend to buy a house and then your girlfriend leaves you. I'm not saying that happened to me. They deal all the papers, and then you don't know what the hell to do. And then, oh my God, it's lasted for, okay. There's an ownership of the assets, and it's like you own the shares and you get voting shares and you get a ownership percent, and then there's a different cash flow percent, which is how much you invest and then what kind of dividends you get back. So this cash share, I'm gonna and then I don't know what in the heck this is, because this is not really this. This is the dividend share. Okay, how about this? Ownership share. Now the only thing bizarre about these things is that we have different ownerships pre and post flip. Now, it probably would be a little bit better to put these on the side so you can be exactly the way Kenny is, but I'm not going to get that kind of crazy. And so this is all the assets, all the income, everything really on the financial statements get allocated like this, except for one thing, control minus, except for one thing, and the one thing that does not get allocated like this is the cash flow distribution. Now, if we put a cash flow distribution in here, okay, if the cash and again, oh no, what did I do here? This says pre-flip and post-flip. This should be, okay, this is the tax equity pre-flip and post-flip, fine. And the tax equity gets 0 here, and that means they get 1 minus, that means they no, they get 1 minus the other party here, and these people get 1 minus this. So what happens here is that all of the cash flow goes to the tax equity at first. I mean, to the pre-flip here. It's almost, should we do it? We're gonna have to do it like this. Okay, let's put tax equity and put it like this. I think that's a better way to show it. And then we put sponsor and tax equity pre-flip. And I'm going to stop here. Sponsor pre-flip, and then we put a post-flip. Okay, and then we stop here. Okay, and then we put the dividend share. We'll do the same thing, but I'll leave that for now. Okay, hopefully the thing I really want to clear out is that for so much of the allocations, it's this thing that matters, and it's only really the dividends that are the rest. And then this is, it says preferred yield, and this is tax equity preferred yield, and we should put percent of investment, and you can put then PA because it's our model is quarterly. Okay, and then we go through our bridge loan, and then hopefully we'll get down here, and I don't know what the heck this is, but we'll have to do this in the next one, and that's where we'll put back. Oh God. Okay. Funding sizing, and then we'll put the funding, and the sizing is driven by this one, and they put this nice thing, oh, it's got to be investment grade counterparties, and we're going to have to do it with P90 and P50, and then we can put the repayment here somewhere, and again, the whole thing is kind of a little bit ridiculous. These dates should be right on the bottom and all of that. Please, setting up the model. This almost shows it to me. Setting up this model in the correct way is such a big deal. Okay, all right, and not making it a mess. Of course, this step up has to be above here and all of that, but it gives you a preview of the next thing. So now let's go into a couple of the calculations. And in the calculations, I think I'm going to have to make this larger. Sorry about that. While I'm working on it, in at the very end of the sheet, this is where I left off. I moved a couple of things around. Now we did the hypothetical tax, the hypothetical IRR with no taxes. Now, when we did this, when you get to this famous period when we're getting all the ITC and we have these gigantic cash flows, 124 cash flows compared to what we've spent, this is when you're getting the ITC back and you're paying the development fee. So we had a lower cash flow here because we paid a tax on the development fee. But pretend you're going to now sell part of your investment, especially as the developer, not as the tax equity, as the developer. You want to bring another investment in. And you've taken this risk. You have gone through and taken the risk of paying, of making, in this case, about 5 or 6 projects to get one success. That's where we got the development fee as a percent of the development cost. Or you could say that's 1 in 10, something like that. Now, you might not believe that, and you might argue like crazy about it. And your other sponsor is going to say, oh, no, you didn't take that much risk and all that. That's how you do that development fee. Okay, and that development fee is up here, and hopefully it's easy to find. And I almost should have, I called it development fee write-up. That's good. Okay, and then we put that here. And then when you do your, now, let's do I think we should perhaps do both of them. Let's do pre-tax cash flow. Silly thing. Pre-tax cash flow less development fee. And you have to tell those partners that this is a real cost. That development fee, it's just like you bought it from somebody else. So we're going to take that pre-tax and put a subtraction on the development fee. And then we're going to put now we'll put the pre-tax IRR less the development fee. Okay, and whatever. So I put it in this one. So again, X IRR. Okay, and we take this one. So that first IRR we computed was not really an economic IRR. And now our IRR is down to 1.23%. Because we're saying that whenever we make an investment, we have to recover all of those other lost investments. That development fee, if we're honest about it, is not just some gimmick to get some extra ITC. It's a real it's a real cost. And those other people, all they're doing, they're just making. If you're getting a co-investor, they have to take responsibility and pay you, essentially pay you for that development fee, or pay a bigger upfront percentage investment in that includes the development fee. And you've got to really believe that when you're negotiating. And you've got to really believe that that development fee comes from somewhere and it's not just an arbitrary bunch of crap. Okay, and then we can do the same thing with now let's do it with the after tax. Okay, and then we'll put it here, and I'll probably stop here. So let's put after tax cash flow less the less the development fee. Okay, and all we do is take the cash flow we started with and put a subtraction on the development fee. So we're a little bit careful, and again, we really have to believe this. Okay, so that's our after tax, but this doesn't have taxes on the development fee, which is another issue. Sorry about that. And I'm not going to do any more because that will just be too irritating for you. Okay, again, the ideas. Oh, shit. Okay. I just want to see what it is. Okay, and this is the amount. If you can get away with, maybe we should have put on that, if you, assuming you could get away with it. So now our IRR is not quite as attractive. It made a gigantic difference, really, if we say this number versus this number. And if you really believe the development fee, that's the miserable kind of return you're earning. And maybe you don't call it a miserable return because that's taken out the risk. That's the return. That's the return you need once you've removed the risk of that development fee and kind of separated the economic analysis between your startup phase and your mature phase. And that's the kind of IRR you need after the development period, essentially, on your mature phase. I hope I've expressed some of the ideas. You can maybe express them a little bit better. Now, once we have this, now I'm on the next page, and now what we're going to do is split this thing up, and this is what I'm not going to do in the video. And I'm going to have to put it in the next video. We're going to make an income statement, okay, and a balance sheet and a cash flow statement. And when we do this, maybe this is going to get a little bit long, this page. And did I started in column C, it looks like, okay. And shoot. What did I just do? Okay, let's do it a little bit better. We're going to take this famous three-statement financial model in thousands, this famous three-statement financial model, and we're going to put it down here. And what did I do here? Okay, I've got a different format, of course. Oh, shit. Okay, I put. Why didn't that work? Okay, I'm gonna put these over here. Okay, and then we'll put this one over here, and we're going to take this famous three-statement financial model, and we're going to put that and allocate it on the basis of the income distribution. On the basis, it's kind of like the percentage of shares you own, okay, and we're going to put that onto the we're going to do this for the tax equity partnership, the tax equity partner, and then we're going to make our three-statement financial model. Also, we'll copy this whole thing down, and we'll do that also for the sponsor, okay? So please, instead of being one of these people who say, I'm just going to go copy things, I'm going to be able to be so fast in Excel because I go and all that stuff. Think about what you're doing. Please, that's the idea. And this is for the sponsor. And when we allocate things, everything is going to be allocated in this whole model, including the taxes on the development fee and everything else, and everything else, yes, the dividends, everything else. Okay, excuse me, I don't want to quit. No, no, no. What did I just do? Did I just screw up? No. Okay, okay. I hope I didn't. Okay, I'm already 40 minutes into this stupid video, this torture for you if you could possibly do this. So we're going to take our total, we're going to get the transferred variables. These really come now from either the pre-tax cash flow or the total partnership cash flow, and we're just collecting them. That's why they're green. And again, of course, that's why you do this with the generic macros. I have to do this, sorry. I'm doing this. No, I don't need. Sure, I'll delete the format conditions, and then we'll go, and we've got all we've got rid of them all, and then I think we're okay here. I'm using this style, and we're using a flexible input color that we really don't have, and then how many things do we want to put on the top? We want to put on the top. I can't remember. Let's put 8, and we'll do that. Okay, and if it doesn't come out right, screw it. Okay, you can see that. And then I put these little things in, which you can go to the generic macros and see how it works. Put these little, they're called forms here, and it sometimes does this, and I should have put 9 here, but so what? We've got it all recolored. Okay, and okay. Okay, so the first thing we'll do is we'll see, just like hopefully this time we'll start with the contribution. How much is the tax equity contribution? And the tax equity contribution is this this amount of the ITC, and then the total capex we get, and we say, okay, I'm going to put what percentage of the total capital is invested by the tax equity, and now I'm going to spread that over quarters. Again, I think it would have been better to do this whole thing on a month-by-month basis, because eventually when you finance this during construction, you want it really in detail. And this time, we could have gotten a little bit more advanced. I think I'm going to leave it for now, but we could have, this tax equity, they're not going to really, no, I've got to stop this. They're not going to really invest during the construction period. So what we really needed to do is to get one more variable, and that was our development cost. Now, I really thought, in some crazy way, I thought, this is going to be so easy. This video is going to be too short. It's going to be too boring. I won't go and digress all the time. And I'm going to just show you how to make these allocations. And of course, I was wrong. And I don't care anymore. It really doesn't matter, does it? I mean, 1 or 2 people might look at this. And then where in the heck is our development? Here are our development expenditures. Okay, and we can then put maybe a construction. Okay, and what, because the real thing here is, and this is the difference, maybe that won't be green when we do it, and then we press Shift Control V for Victor, and it gives us the total. And this, so that we should have put here total construction. Presumably the tax equity is not going to come in and take the development risk. That's what I've been babbling about so much. So now we've got a little bit higher percentage, and this amount you're going to spend is going to be this as a percentage of the, and I hopefully I don't have to work through how to take the variables for the other side. And if you really wanted to do this, maybe you could put a little thing here. I think it might be better to put something here. Something like this. Okay, maybe that wasn't a great one. How about we'll put with a percentage sign to make it shorter. Okay, put little things here instead of putting this on a separate line, blah, 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 and then you can, so this is still a USD thousands. Okay, and then so the remaining, now the sponsor is funding all of the rest of this. And oh shit, I had some peace down here, and now I'm going to get interrupted again. God damn it. What? No, God, I gotta pause my video now again? I'm struggling with this shit. Okay. I don't want to. Now, where I lost my train of thought now. Okay, now once we have the contribution, I happened to start here with the income allocation, and this should be fairly straightforward. We take these, we put the this could be flip if you want to write something down. Again, I think you can be very flexible with this kind of stuff. And then post flip, okay? And okay. Okay, and then we get our total income, and our total income, I hope, comes from here. Now this is the income is the income here is we should be really careful. That's the EBITDA minus the depreciation, and we could allocate the income also from the amortization of the ITC and this development fee, and that development fee tax theoretically should be part of this income, but I'm going to put total income EBITDA less depreciation. Okay, and then we put this, and I really should here add, which I just can't do right now. I'm sorry, it's just too detailed. We should add that income on the development fee if you're going to include that as income. Okay, and then finally, to get the three-statement financial, the three-statement model together, we should even add the amortization of that ITC. And when we amortized it over the entire life, there might be some distortions in the post from the switching from the 99 over the 5 years to the later on. So those could be a little bit complications, but once you get that, you can just allocate the income, and I'm just going to stop here, and then we put a tax rate, and then we get taxes on the income, and they want it to be negative, of course. And then because you're switching up here, and this is, remember, quarter by quarter, then you've got to switch, and you've got to pay if you've only got 5%. So when the income goes up after the tax depreciation is finished, you've got positive income, and you're taking less of the positive income. This is this whole business. Now, if you're saying, oh God, all this is the tax equity, they're just getting the ITC and depreciation. They're not taking any risk in the asset. And that's what the government wants to protect against. And that's, I have to have a whole nother video on taking these three-statement financial models, three statements, whatever, three financial statements, whatever you call that, And then we have to put these constraints in to evaluate the equity. And then we've got the total amount of the contribution for the tax equity. Again, I just repeated it here, so fine. And then we've got a preferred yield. And remember, this is divided by 4. And with all these range names, we should have put the quarters per year here. And did we put the quarters? Yes. So that should have really been something like that. And then we got that. And then that preferred yield is just over excuse me, it's over the pre-flip period. Okay. And again, there is absolutely no formula that's anything complex. Okay, and then we get the allocation. After that, we put the allocation, the cash flow allocation, and that's on a completely different basis. Because of this preferred yield up here, the tax equity gets nothing, and then the sponsor gets everything else. And I've got to go somewhere in a little while, so I'm trying to finish this. And then the cash flow is just the EBITDA. We don't have any working capital. If you put working capital, so what? You can get that. And when you do this, you've just got to account for the preferred yield, I guess. It really doesn't make much of a difference because that's total. That's the only thing the tax equity get, and then in this case the way they allocate it, and I assume that's a very realistic kind of allocation. The rest of the money goes to the sponsor. So you just list it out. You list out the percentages. I hope this is okay by not doing this. And then you can go through the cash flow, and we can start with the tax equity investor. We can see how much they've contributed. Perhaps I've got to make this a little bit wider. And then we put what they're getting in terms of their preferred yield. And then you get what they're receiving in terms of the ITC. And this is where it really could have been adjusted. That tax equity presumably would be responsible for the taxes on that development fee write-up. And then we put the tax equity return, and I get an IRR of 0, and that should be because this, why is this minus 0.0001? Okay, sorry about that, but I guess that's what I should have been telling you. And some people, the auditors get, oh man, I hate this. Oh, you can't put that 0.001 because the formulas aren't consistent. And I get all these stupid notes about this, and that's a really high return. Now, what this is the tax investor after tax and no stranded investment, stranded tax, which means no constraints. The other thing you could do is you can put and then you can do the same thing for the sponsor. And why did that work? I don't know. Did I put oh, that's because, it was because of that development fee stuff. That's why I had to do it. And up here, you could even do another little analysis, tax equity, and you'd think, what are you doing here? Tax equity pre-tax. And that you'd say, why would you do that? Well, let's take we'll take the contribution and the preferred yield, and then the cash flow allocation, and get a total. Okay, and the reason we're doing this is theoretically that tax investor is supposed to have a minimal IRR they're earning, and you can say that preferred yield is really not an at-risk investment, but they would you would, for tax purposes, you'd say that. So these are all positive, so we'll take alternate equal, get the sum. Okay, and then we'll put this whole thing in here and get the TE pre-tax, and they're supposed to get some kind of minimal return to show that they have an at-risk investment. So let's put this XIRR and then put the dates in. Okay, and this one, when we're doing this, we're not getting anything, and maybe because we're getting a negative investment. And I don't know what to say about that, but I'm just going to leave it in. The idea, do we have positive tax? We've got some positive cash flow towards the end, and okay, we're not getting it. But maybe for this calculation, I'm sorry, I don't know all the details of this one. Maybe you can adjust it for the ITC. Okay, and then we put the sponsor, and we can see what they're getting after tax, and they're getting a much smaller allocation, even though they take more risk. And just to kind of continue, if you wanted to really get detailed, you would also say down here, this would be the after development fee. And the development fee for economic purposes, not for accounting purposes, for economic purposes, you'd allocate all of the development fee to the sponsor. And I suppose I'm really not sure about this one, but you could argue that tax on the development fee should go to the sponsor and not the tax investor, but I am absolutely not sure about how that allocation would work, and I have to just admit that. And then for the sponsor, what people will often do is do everything on a pre-tax basis. And the reason you do this on a pre-tax basis is because the sponsor might have all sorts of net operating losses and might not ever be able to use the tax benefits and all that. And maybe that would be something you could also do with the taxes on that development fee. Okay, and then once we have that, well, we'll just allocate the EBITDA. We've got the allocation up here of the EBITDA. Okay, and just a minute. This would be, we'd have to allocate that based on the income percentages when we do our three-statement financial modeling. So we could put another line up here. Okay, and that's not really for cash flow purposes. It's a little confusing. That's for income purposes. And since we gathered everything here, we could put a multiplication and get the allocation to the tax equity. And we could have shown perhaps the depreciation as a separate line. Okay. And I hope you kind of see how it's working well. I didn't put the depreciation in here. We'd have to put another line for depreciation. And I'm hoping, really, I'm kind of just rambling on right now. I'm hoping that you see, well, setting up this model is such a key thing to do. And I'm going to do something. This is torture. I'm going to give you the model. If you're really interested in this stuff, you can work through the model. I'm going to put these financial statements together, and then put a couple of checks that the financial statements from the God, I got too many underlines on that one, don't I? The the allocation of the total partnership fits into this allocation to the partners. Okay, that's really what you do. And then we're going to have another page that works through the limitations, the constraints, the DRO, the suspended loss, this excess dividends, and try to really understand, try to put your mind in some kind of negotiation or some kind of discussion that the tax authorities must have had at some time uh, 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 with whoever, with politicians, whoever finally put these things together, these ridiculously complicated things together, and try to put a little bit of understanding of where these things might have come from. So I've got to stop now because I've got to go, and I'm gonna leave that piece of crap video. You can give me a negative thing. Please don't give me a negative thing. Just turn off the video if you hate it. Should have said that much before.